In 2025, one protocol accounted for nearly half of all crypto buybacks. Today, that same protocol has reached a brand new all-time high. That protocol is Hyperliquid, and its token, Hype, is currently one of the most debated assets in decentralized finance. The debate centers on two massive competing forces. There is an aggressive engine permanently destroying tokens set against a schedule that releases new supply into the market every month. For an investor, the dilemma is clear. You have to determine if these mechanics support a long-term hold or if the volatility makes it strictly a short-term trade. Capturing the potential of this token requires acting on these tokenomics before the broader retail market fully prices in the burn rate. Choosing a community-led launch over a venture-backed one changes where the value comes from. Instead of a VC bankroll, the token's strength depends entirely on the protocol's ability to generate its own revenue. This chart maps the Hyperliquid architecture. It is a proprietary Layer 1 blockchain built specifically to power a decentralized exchange. The system provides the execution speed of a centralized exchange while keeping the security and transparency of a decentralized layer. The project was founded by Jeff Yan, a former quant trader and Harvard graduate. Its distribution was unusually broad. In late 2024, 31% of the total supply was airdropped to nearly 94,000 early users. There were no seed rounds and no venture capital funding. The project relied entirely on organic community backing from day one. This provides a high level of community ownership, but it means users are navigating a new ecosystem without the institutional backstops found in other major Layer 1s. To evaluate the ROI, we look at the hard limits. Hype has a strict 1 billion token cap. Currently, about 220 million of those tokens are in circulation. The engine driving the price is a fee split model. 97% of all trading fees are used for open market buybacks and permanent burns. This isn't just a theoretical mechanic. Over 41 million tokens have already been destroyed and removed from the supply pool. This creates an annualized buyback rate of roughly 7% of the market cap, which is significantly higher than the rates seen with Ethereum or BNB. This creates a mechanical floor. As long as trading remains high, the protocol acts as persistent buyer, supporting the price through deflation. A 7% buyback provides a strong tailwind for holders, but it is entirely dependent on trading volume. If the exchange goes quiet, the burn engine stops. On the other side of the ledger is the primary risk that traders have to manage, the contributor allocations. Every month, nearly 10 million new tokens unlock and enter the circulating supply. These unlocks work directly against the fee burn. The price of Hype is essentially a calculation of whether the burn can outpace this new supply. It is a constant race. To maintain value, the exchange's volume must stay high enough to buy back more tokens than the monthly schedule releases. The trade-off is clear. To benefit from the protocol's revenue, you have to accept the risk that a drop in volume could allow this monthly dilution to pull the price down. Looking at the current chart, Hype is trading around $63. This price is roughly 16% below the all-time high of $75 reached earlier this year. Technical support has formed a floor near $55, a level where the market has previously stepped in to buy. If the price breaks $75 resistance, it clears the way for the chart to test the psychological $100 mark. Buying the current dip is a bet that the combination of price appreciation and the 7% buyback yield will outweigh the cost of entry. The downside risk appears if the $55 support fails to hold during a monthly unlock. If the market can't absorb that new supply, the price could drop quickly. An entry near $55 offers a high probability setup for a breakout, but it requires you to exit quickly if trading volume on the exchange starts to fade. This scorecard summarizes the strategy for Hype. The protocol has established revenue-backed mechanics, but it requires active management. First, the fundamentals are driven by real trading fees and a lack of VC sell pressure, which is rare in this market. Second, you must track daily exchange volume. The burn engine only protects your investment as long as the exchange is being used. Finally, be cautious around monthly unlock dates. These are the windows where supply pressure is at highest. Relying on a 97% buyback creates a unique growth opportunity. The trade-off is the need for hypervigilance to ensure the monthly supply releases don't overwhelm the market. If you found this helpful, smash that like button, subscribe for daily crypto breakdowns, and share this with someone who needs to see it. Drop your thoughts in the comments. Are you bullish or bearish on this one?